Good morning, everyone, and welcome. First of all, a very important administrative thing. Many of you, I noticed, have already found on the agenda on your table there is a QR code. If you scan that, you will get everything you need. Copies of the presentations, bios of the presenters, and also some additional material that people have provided for us. Now, Toby's talked a little bit about what an exciting year we've had and what might be exciting times ahead still. I looked back, some of you would have been at our conference this time last year, and it was all about inflation, interest rates, and this year we seem to be still talking about inflation, interest rates. Now we're talking about banks collapsing, as Toby hinted at, which sounds like really bad news, but then I read this morning that maybe it's good news because it'll make the Fed ease off a bit. So, there's always two ways of looking at these things, and some of our speakers today, I'm sure, will give us an idea of what's the best way to consider some of these. We've got sessions today on everything from global and local equities to fixed income and alternative assets. And we've also got one that looks at not just whether net zero is something that we should be aiming for from an environmental point of view, but whether it's actually something you can invest in. So that should be quite an interesting session. The big picture obviously is a good place to start. I mean, I've mentioned inflation, interest rates, etc. Our first speaker is going to look at that. Our first session is going to give us Bob Cunneen from MLC. Bob is the Chief Economist at MLC Asset Management, and he's going to talk about global influences on domestic equities. Please welcome Bob.
Thanks, Toby, and thanks, David, for the invitation to speak. Now, obviously, the events over recent days have been quite dramatic, and this presentation was set in stone on Friday, so you can imagine how relevant I feel at the moment, but I think you're accustomed to economists either being dangerous or hopeless, and I'll let you decide which category I fall into. So I might need a little bit of hand with the presentation, David, how to click it forward. Now, a word of warning, I have a very dry sense of humour. Some say a drought's been declared. So I'll open it up to questions as we go along. So let's keep this conversational. I much prefer a dialogue to a monologue, if I could put it that way. Now, the topic was global influences on domestic equities. Okay. And it's pretty obvious, Wall Street is probably the key driver of our market. But I want to touch on the China influence as well. And I want to take a little bit more of a perspective on that. I've left out Europe, I've left out Japan, I've left out most of Asia, but that's just, to simplify things as well. Now, two smarter economists than this speaker warned about relying on economic forecasts. Okay. Now, Keynes was not only a great economist, but also a great investor. And he always warned about, the potential for shocks and surprises. The inevitable never happens, the unexpected always. Okay. So what's happened in the last 4 days is a reminder of that. Okay, and it basically says that as soon as you rely on a statistical relationship, it collapses. Okay? So whenever an economist comes with a range of indicators and says this is the one to follow, you probably have to discount it. So hence my presentation has a use by date which was as of last Friday. Okay. I'll try and adapt as we go along. Okay, so the blue line, Standard & Poor's 500, so Wall Street's benchmark index. Okay, we start off at 100 back at the start of 2020, so before the pandemic actually hits. Okay, and you can see that huge roller coaster ride that we've been on. Okay, the sharp fall, March of 2020. The huge recovery that we had up until the historic highs recorded early last year. and then the downward slide, minus 18% for the S&P last year. Now, the green line is the Aussie market, okay? So we were only down about 1% last year. You can see the correlation between the Aussie market and the US market on a correlation basis over the last 3 years. It's about 0.9. But we didn't keep pace, obviously, with Wall Street. And why is that? Why is the Aussie market relatively underperformed? And I think it's the China story. And I think we've missed this in the sense that our largest trading partner has inflicted a lot of damage and constraints on their own economy. And I'm talking specifically the Chinese government. So if you look at the Chinese share market as represented by the Morgan Stanley index, so large and mid-cap stocks, you can see the huge roller coaster the Chinese shares have been on, okay? It made a peak in early January of 2021, okay? Now, what has weighed on the Chinese share market, and bearing in mind the subsequent falls has been about 60% to its lows late last year. Now, there's three factors that have been at play. It's obviously the zero COVID strategy. So whenever you have a lockdown, or a virus outbreak, you have a lockdown. But it's also the tightening the screws on property development, so in leverage terms. So your Evergrande is the obvious case. But it's also the incredible scrutiny on technology companies, your Alibaba and Tencent. So what I would say is, and this reflects economics, is correlation is not causation. So even though the Aussie market is tied or closely correlated to Wall Street, what's causing our relative underperformance relates back to China. Now, the inflation story. Okay, so as David mentioned, it was a problem last year. It's still a problem. Okay. However, the inflation dynamics are suddenly changing. And that's what we've got to be conscious of. So if we look at the US inflation, so on consumer price basis, peaked in June of last year. It has come down 6.4% as of January. So tonight we get an update. Market is expecting it to come down to 6%. Do we have the all clear on inflation? Well, from the central bank's perspective, the Federal Reserve, no, because their inflation target is 2%. In the case of Australia, you can see our run-up, and note it is a delay or is lagging compared to the run-up in US inflation. So this is the monthly measure. It peaked at 8.4% in December. It has come down to 7.4%. There is the expectation will come down to around 4.5% by the end of this year. But bear in mind, again, it's a forecast or an expectation by the Reserve Bank. So you've got to put a question mark about it. Again, we come to the China story. Now, this is interesting because China hasn't had an inflation problem. But again, China is important because it's the factory to the world. And China has been a source of the inflation problem because it's been an epicentre for the supply disruption story. You know, the delay in production and the delay in transport. So, what's changed? What is changing with the inflation dynamics at the moment? Well, it's quite interesting that in terms of the commodity inflation story, and here I'll just highlight oil, that the inflation risk in commodity prices is rapidly fading. So think about it, the black line here, Russia invades Ukraine, February 2024. Your oil price goes from roughly $70 a barrel up to $120 US dollars a barrel. Now, what has been a surprise over the last 6 months, see how that oil price has come down? Now, that's a combination of the slower global demand story, and it relates back to China. So you slow down in China. But it's also, we've had a positive surprise with a warmer winter in Europe. So by virtue of that, that commodity price inflation has rapidly faded. So that's a positive for the inflation story. It should come down. The other key positive surprise is the purple line. So your shipping cost index, if you think about it, 2 years ago, it was around 1,000 on an index basis, shot up to 4,000. So it went up by a factor of 4. It's now come back towards that 1,000. So again, the global inflation dynamics are now turning down. Okay, so that's a positive story.
Do you mind?
Yep.
Use the microphone so that we pick it up. So the key point here is you believe the trend in oil prices will continue down?
Well, even if it goes sideways, the inflation impulse that comes from oil prices has basically extinguished.
So you believe that the strategic drawdown in, say, the US that's continuing to flood the market's going to stop, and the demand from China, which is picking up, is going to offset that, and all those dynamics that you probably haven't mentioned is not going to happen, or?
Well, I'm very sceptical about the China growth story. Okay, so in essence, the China reopening, China growth story is not going to propel that oil price higher, because instead of your 5% growth target by the Chinese government, you're more likely to get what you had last year, as in 3%. So the Chinese government has to change this scrutiny about technology, education in itself, has to take the pressure off your property developers, stimulate the housing sector. And at this stage, that's not been seen. So once the oil price just keeps going sideways, your global inflation story is no longer has a source from your commodity price story.
So when will the US start buying back their strategic reserves?
Well, who knows? Who knows? They might wait until it's $60 or $70 a barrel. Okay. But I remind this audience, there's a famous saying about from Sheikh Yamani, and it's just a reminder that we are going through probably the end of the oil age. Okay, so with renewables, this reliance on fossil fuels is going to dramatically transform it. And Sheikh Yamani, if you remember the 1970s, he was the oil minister for OPEC. He just basically said the Stone Age did not end for a lack of stones. Okay. So I would argue the oil age is coming to an end. Now, just on that shipping story, so again, your supply chain disruptions impulse to global inflation is now, again, rapidly fading. However, this doesn't signal the all clear on inflation. Inflation is likely to only gradually come down over the next year. And it's particularly problematic in the services side. And I think what's probably the best illustration of this service inflation is what's happening with rents. So you can see this huge surge in rental costs in the US CPI, up at 8.6%. And in Australia's case, now the ABS measure shows rents are only going up at 4.8%. Now, those of you who are renters in this audience, you'd be surprised by that, because if you're renewing a rent at the moment, It's going up at a 10% plus pace. So your problem with your measurement of your CPI is it measures the volume of outstanding rents. As new rents come into that volume, the annual change picks up speed. So we're not really capturing here the inflation dynamics in rent, but they're going to head higher. Now, we can also talk about electricity prices. They're potentially going to go up 20% this year. So again, that's a reminder of the sticky inflation problem. Now, what's also difficult for central banks to get their head around is the wage pressure story. Okay. And you're seeing this euphemism that central banks have been talking about as the labour market is very tight, or in the case of Jerome Powell, the Fed chair, or tight, as in the RBA Governor Phil Lowe. Now, how do you measure the tightness in the labour market? Now, one rule I would try and avoid is measuring unemployment, because unemployment by itself is a lagging indicator. There are a lot of parts to it. But I think this is a very simple measure you should focus upon. And what this is the number of job openings compared to the number of unemployed, the level of unemployed. Okay. Now, just to show you how tight the American labour market is at the moment, if you follow that blue line, you can see that there's 1.9 jobs outstanding for every unemployed American. So more than 10 million jobs openings to 5 million unemployed Americans. Now, that's well above normal. Okay. In Australia's case, and this is the reason why we don't have the wage pressure story that the US does at the moment, you can see by comparison, we have about 0.9. So less than one job opening for every unemployed Australian. Okay? And it explains the differences in the inflation performance at the moment. So what you can see, the labour market is tight, but I'd probably emphasise here, it's not getting any tighter. Okay? And in the case of the United States, job openings are starting to come down, which is quite interesting. So again, it's a reminder the inflation dynamics could rapidly change. Now, the other indicator to watch, and what I would emphasise here is that do not spend your time reading or listening to central bank speeches. They are as boring as batshit. Okay. Just focus on what the 2-year bond market is telling you. Okay. So to illustrate that point, let's look at the chart on your left-hand side. So this is the 2-year government bond yield, okay, in green. Now note how it leads, but sometimes overestimates what the central bank is going to do. It's not a perfect indicator, but it has led the rapid rise in interest rates that you've seen in the last year or so. So what's interesting now is that if you went back a week ago, that 2-year government bond yield was at 3.6 and above. As of yesterday's close, it was 3.24. It's probably going to go below 3.2 today. Okay? And what this is actually signalling is that we are near the end of the interest rate tightening cycle. Now, if we turn to the chart on the right-hand side, which is even more extraordinary, okay, here's your US Treasury 2-year yield. Okay, you can see the huge surge that we've had over the last 16 months. You know, we're down at 0.1. We surged above 5% early last week. Okay. Now, as it now stands, in the last 3 days or so, it has come down 80 basis points, or 0.8%. And the important signal is that the Fed is going to find it very challenging to raise interest rates next week in this environment. Okay, the bond market is saying there are significant problems in the banking system at the moment. This is a significant dislocation that's occurred. I'd be careful and say we are not quite at the financial crisis stage, but it definitely puts a question mark amongst Fed policymakers whether they should continue to raise interest rates. But let's see how the next week goes. Now, just to focus on a few other indicators that you should watch. And so, your consumer sentiment indicators. Now, bear in mind, this is how consumers respond to surveys. It's not exactly what they do in terms of spending. So what has been remarkable over the last, say, 6 to 9 months, is that retail spending has held up quite strongly, but consumer sentiment has plunged in both the United States in blue and Australia in green. Okay. But what you're starting to see in retail spending is that it's not keeping pace in nominal terms with the rise in inflation. So that in real terms, real spending is now starting to weaken. And that's a warning sign that the economy is under strain. Okay. And what's interesting is that if you look at these consumer sentiment figures, so in Australia in green, this is the Westpac Melbourne Institute's survey. So we've got one, the latest is for February. The latest is for February. We get the March update today. But if you look at that green line, consumer sentiment is basically as weak as it was March, April of 2020 when the pandemic hit. So your consumer is really feeling the squeeze from the cost of living crisis. Okay. Now, the other indicators to watch is basically what's happening with housing starts. So if you think about new houses, apartment construction, what's quite interesting, if you look at the US and Australia, you know, the sharp falls that we've been starting to see in housing construction. So, you know, the painful squeeze in cost of living and in terms of interest rates is feeding through into the demand and the supply of new housing. So that's a warning sign. Again, the economy is under strain. The downside risk to economic activity. But I just put in contrast there China. Again, comes back to that earlier question about the China demand story. You look at housing construction there, it's down nearly 40% compared to your starting point 3 years ago.
Oh, okay. So long as she's here.
So, again, China is important. And it's particularly important for Australia because, you know, we're a major commodity producer, particularly iron ore. That feeds into the Chinese steel industry. So, arguably, maybe the mining sector is too optimistic about the China growth prospects. The final slide is your house price story. Now, what is remarkable about this is it's pretty obvious in Australia that, you know, we're concerned about the recent, 8% slide in national house prices. But bear in mind, compared to 2020, we've still got house price gains of 15%. So your wealth effect from falling house prices regrettably will build over time, and that'll weigh on consumer spending over the next 9 to 12 months. Okay. The China story, okay, here I've got to put a big question mark about the reliability of Chinese data, okay. It's remarkably smooth what their house prices have done, and the pretty steady gains, despite the property developer woes. You've got to be sceptical, okay. But what's really interesting, United States, the blue line here. Look at the huge run-up that you've had in the United States, okay. Now, this is the Case-Shiller measure, okay. It has its limitations. It's a bit smoothed over a 3-month basis. And the housing market has only come off 3%. But let's put it in context. Look at the huge run-up you've had over the last 3 years. Okay. So I'll end with a note by a distinguished economist called Rudy Dumbush. He said basically to the effect that a crisis takes a long time to develop, but then suddenly turns up. So bear that in mind with my previous comments. So thank you very much, and I might hand it over back to David.
Questions for Bob?
Bob, sorry, over in the corner here. If I can ask you one. You talked about very low and falling consumer sentiment, job vacancies coming off a bit, and house prices falling. Do all of those things lead to recession?
I'd emphasise they're warning signals. So you have to look at a range of indicators and not rely on one. So I would say the consumer is the weak spot or the Achilles heel of both the Aussie and the US economy, apart from the US banking system. But you have to look at other indicators. You have to look at things like business surveys, things like car sales. So again, the consumer may be pessimistic, housing may be struggling, but if a consumer is willing to go out and buy a car, again, all too frequently, as I said with Charles Goodhart's law, is that economists rely on singular indicators, and you've got to take a broad range to make a judgment of a recession. I'd have to emphasise the recession risks are becoming more and more prominent, and what's happened in the last 4 days is particularly problematic for the US economy, if it builds. So your Silicon Valley signature bank becomes more of a regional bank crisis, and then it feeds into the money centre banks. Okay, so it's important that the contagion is limited.
Here we go. Yep.
Bob, in terms of inflation, so if you go in the historical data of like 200 to 300 years ago, and then the inflation was checked somewhere around 2%, So, but now this is not the case, like where the inflation has gone up to 7, 6, or whatever in different countries, but whatever the US said, the other rest of the world is not different. My question is, if you want to check the inflation as per the central bank targets for 2%, where do you see, the cash rate would be? Because at the moment, the cash rate is pretty much lower than the inflation, but in the historical data, cash rates always be above than the inflation.
Okay, so you're asking a great question, and you're asking what is the neutral rate. So what is the neutral interest rate where it's above? If it's above this neutral rate, it means interest rates are restrictive, the economy dramatically slows, and inflation risks evaporate. And let me just say, it's like the natural rate of unemployment. Nobody knows, okay? Central banks don't know. Now, there's various estimates say in the US, if you look at their long-term run projection, it's about 2.6. If you look at other estimates, it's probably 3.5%. Okay. Similar story in Australia, would probably be put it between 3 and 4. So arguably, we are not at restrictive. But what I want to emphasise here is your commodity price supply chain disruptions looks like a shock, a longer term shock than central banks expected, as in let's abandon the transitory, but a shock that is now fading. Okay. And for your inflation to continue, you need that rent wages story to become very problematic. Okay. Now, I think they'll eventually fade because the slowdown in the economy will take the edge, particularly off the wages story. So you won't have the job openings, vacancy ratios that high. They'll come down, and your employee won't have as much bargaining power as he has now. Okay. And that's the reason why I'm going for a pay rise at the moment. I know it's a brief window of opportunity.
One more question over here.
Yes, Stuart Gray from Staten. We've seen Sydney house prices fall circa 15% over the last 12 months.
Yeah.
And I suppose increases in interest rates may imply that that would go further. But on the other side, we're seeing substantial delays in supply coming online and Sydney sort of upticking over the last month and a half. How do you see that playing out for the rest of the year?
Well, I'd probably emphasise that there's still a downside risk to Sydney, probably 5 to 7%. And I'd emphasise here that what's probably held the Sydney market up over recent months is basically the summer silly season and a shortage of stock. Okay. But I think the interest rate story, in terms of your variable mortgage now, even if you get a discount, is 6%. So I'd emphasise, you know, a lot of us talk about the mortgage cliff as in the fixed rate loans rolling off. Okay. So that's 35% of housing mortgages. But I'd emphasise here and now it's the variable vice that is squeezing the demand for housing. So it's not only the interest rate pricing, but your capacity to borrow. That's also come down because of the level of interest rates. And with that, you know, the downside risk to the Sydney market is still quite significant. But, you know, as the old saying goes, location, 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 if you went to Adelaide or Perth, you know, it's not a problem in the sense that, you know, they didn't have this huge run-up in prices. So the affordability. And the affordability, that's why I tell my kids, go west. Because I'm sick of them living in their house and they're in their mid-20s. Okay, thank you very much.